Roughly 25 to 30% of their revenue goes down to free cash flow. The margins in this business are absolutely ridiculous. Welcome back in, investors. Today we're going to talk about a cybersecurity stock specifically designed for customers. And with all this talk about AI and how we're so connected to the web, I definitely think cybersecurity is needed more than ever. And this stock specifically has been beaten up, so we're going to try to get a fair market value, and then we're going to put a rate of return we're looking for to buy the stock. The stock we're talking about today is Gen Digital. So let's get into it. Gen Digital has a pretty interesting portfolio here. These are all familiar names I think we use on a daily basis. And so we're going to go over exactly what's been going on with Gen Digital. As the revenue's been up and down, they've recently acquired Avast for $9 billion. First couple things I like to do before I dig into a stock is just take a look at the financials really quick here. As we can see, going back to 2014, this company was doing nearly $4 billion in top line revenue. And we could see here that revenue just kind of goes up and down, up and down. But a lot of analysts are expecting that this company is going to have steady double-digit revenue growth going forward over the next 5 years. And what I noticed when I dug into the stock is that if we go from basically 2018, it has had steady growth. So it looks like the company is on some sort of trajectory here that I definitely want to keep an eye on. I do think their products are very credible, and I think they're very reliable. And I think overall, when I did a quick glance over the fundamentals, looks very strong. The business looks very strong here. Next, let's take a look at what sentiment is for the stock. What are analysts' expectations here? We get a stock price of $21 to $27. Currently, you can buy as many shares as you want between basically $16.50 up to about $17.50, which is below analysts' expectations. They're expecting to do some pretty decent revenue growth going forward here. So I'm going to project this out, but I'm going to be a little bit more conservative with my estimations. Let's go over to Yahoo and see what their analysts expect over the next 5 years. Now, Yahoo has them doing roughly 14% revenue growth over the next 5 years, which is pretty strong here, considering that this is a more mature company and it hasn't really proven to do that kind of revenue growth. So to see analysts expecting this spike is pretty interesting and could be some pretty good value here, getting in at the right price. They did acquire Avast for roughly $9 billion. And the concern with this is now that the company is taking on a lot of debt, this does kind of hinder their balance sheet. But I went through the history of Gen Digital, and they've taken on debt before, and they were still able to rebuy stock. They were still able to pay out their dividend. So they actually do have strong enough fundamentals, I think, to handle this kind of debt, although I do think it's something to keep an eye on, which is going to lead me to their free cash flow here. They do very strong free cash flow compared to their revenue. Roughly 25 to 30% of their revenue goes down to free cash flow. The margins in this business are absolutely ridiculous. Getting a gross profit margin of 82%, EBITDA margins of 44%, very, very strong margin business. Absolutely dominating their competitors in all aspects, which tells me that this company has a massive competitive advantage. And when we look at valuations here to their peers, we can see that they're trading well below their peer valuations. The reason being, I would guess that they're trading at such a low valuation, and rightfully so, is they deal more with customers who are sensitive to economic backdrops versus businesses who are going to spend regardless because they need to, right, to protect their business. Us as customers can decide to get rid of services at any time, and I think that is the concern going into a possible recession, that people are going to make cuts here. And they did have softer guidance 2 weeks ago. They came out with news saying that revenue guidance was going to be a little bit softer. And so while we're getting 12, 13% revenue growth, I'm going to err on caution here and use about 8 to 9%, undercutting what the analysts are expecting because that news did drop. The other thing is the CEO did pick up shares around $15.50. The CEO believes the company could be undervalued as well. When we look at a price to free cash flow, trading once again below its peers, this company here prints very, very strong free cash flow. The question is going to be, can they really grow the top line at double digits? And so that's kind of where I'm going to pump the brakes a little bit and say, I don't think so, but I'm going to meet in the middle somewhere here. And for all you dividend lovers out there, they do pay nearly a 3% dividend, which they've been paying for roughly 9 years. With the long-term chart in an uptrend, but definitely volatility here as it does peak out to above $30 frequently and then rips back down to roughly $13, $14. So we can see that this could be more of a cyclical type of business here where the ebbs and flows of the customer is really going to depend on the macro backdrop. How strong is the economy doing? Do people have money? Is this a service that people are going to pay for? And I tend to think that the deeper we get into AI, the deeper we get involved in technology, this is going to be a service that we're probably going to see more of a defensive side to, not as much of a cyclical nature to. I could be wrong. This is me kind of just being subjective on this sector individually, which could be a dangerous thing. But I also think getting in a stock like this at a reasonable price probably is not going to hurt you too much, as we see price discovery gets there most times, getting above $25, $30 a share. And I think the overall fundamentals in this company is pretty strong. The one knock I would say is that the recent debt that they're taking on, they haven't proved to actually be able to handle this kind of debt in their company's history. So that's where I would get a little bit more cautious on jumping headfirst into this one. Is the recent acquisition, is this going to pay off? We don't know yet. They recently took on the debt, but we don't know how much they can squeeze out of Avast. And is this going to also impact margins? So this is something we want to keep an eye on as well. So with most analysts expecting basically 10 to nearly 14% over the next few years, I'm cutting that in half and saying that they're going to do roughly 7%. And the years 3 through 6, they do roughly 6%. And the years 6 through 10, they do 4%. So I think I'm being pretty reasonable here with my valuation. A lot of experts believe they're going to do roughly $1 billion of free cash flow. And I'm steadily going to grow that. So even if they miss $1 billion here, I think over the next 3 to 4 years, they will definitely be getting well above $1.2 billion. So I think I'm being fairly conservative overall here. So I'm building safety multiple ways here. I'm building safety and looking for a 12% rate of return here. I'm also building safety in the fact that I'm cutting what analyst expectations are basically in half due to what the company recently reported here. So if we're looking at a free cash flow standpoint here, I could definitely be buying this stock today, basically at that $16.50 mark. Anything under $16, I really feel like this is a pretty interesting stock here. Now, granted, I am getting a fair price at $13.17 from an EV to EBITDA. So I think I meet in the middle here, and I think $15 to $16 on this stock makes a tremendous amount of sense here, getting a price target of 2031 of roughly $33.73. Now, if I want to be aggressive and I think that they can achieve double-digit growth, let's just say I do believe that they can do 10% revenue growth over the next few years and then go down to 6 and 4, then we get basically a price target of around $16, $17 a share here. From an EV to EBITDA, we get $14.50. From a free cash flow standpoint, we could pay as much as to $18 on this stock, and I think that would be pretty comfortable. And as we see here, the stock is basically trading at fair market value. I think where this stock gets really, really interesting is if it does get down to that 15 or below mark. I think there's a tremendous amount of security built in here, no pun intended. I think that there is some upside to this stock. As I stated before, it trades much like a cyclical business here, dealing with the customer. But I think longer term, we could see it trade more defensively and more steady. I think the valuation right now is appropriate, trading at basically an 8 PE ratio and a forward PE ratio of 8.5, paying a 3% dividend. Yeah, I don't think it would be a bad buy at these levels, but considering that the fundamentals are very strong in this business, they seem to be going stronger in the future, and the stock is down 31%. So as the fundamentals are actually getting stronger, the stock is getting cheaper. The question becomes, can they handle taking on this kind of debt? What is their business model going to look like what's their margins going to look like now that they carry this debt? And how much is Avast going to help their overall portfolio? So those are some questions that I have. Those are things you have to watch out for. But I would say this is definitely a very, very interesting stock. Once again, I think this is a stock kind of getting overlooked. When we think about cybersecurity, it's not one that's really talked about in any sort of conversations. And we talk about cybersecurity from a business perspective, but the most vulnerable individuals are going to be the customers, right? They have to find reasonable ways to protect their identity, to protect viruses getting on their devices, right? To possibly hack into their systems. So the people that are most exposed, in my opinion, are going to be the customer. And this seems like a reasonable way to protect yourself going forward in a digital era. So guys, that was my dive into Gen Digital. I think it's a very interesting company. Definitely would be interested in adding some if I saw 15s again. And anything below that definitely gets really interesting as long as they're handling the debt and the margins are not being impacted too much here. As always, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.